What if I told you that your biggest retirement risk might not be the markets, but Washington? Stick with me because today we're going to talk about how your retirement is taxed now and what could happen if nothing changes, and what's inside the newest proposal Congress is floating, something they're calling the One Big Beautiful Bill Act. Let's start with the basics. If you're like most retirees or soon-to-be retirees, your income in retirement, it might come from a mix of things. Things like Social Security, pre-tax retirement accounts like a 401k or IRA, after-tax investments like a Roth IRA, or an employer-based pension plan. These are just to name a few. So here's the key thing. Money that's never been taxed, like in your traditional IRA or 401k, gets taxed as ordinary income when you withdraw it. So the amount you withdraw is added to your income for the year. And for those in a higher tax bracket, that could mean as much as 37% for your tax rate. What about Social Security? It can be partially taxed now depending on your income and your capital gains, dividends from taxable brokerage accounts. Well, what about those? Those have their own tax rules too. In short, retirement income isn't tax-free. And with required minimum distribution starting at age 73, many retirees are forced to take out more than they need, potentially bumping them into the next tax bracket. So what's the concern? Well, we're sitting on a ticking time bomb. Federal debt's past $36 trillion and climbing. And guess what? Most retirees saving in America, especially in 401ks and IRAs, haven't been taxed yet. That's tens of trillions of dollars that the government sees as future revenue. So if nothing changes in tax law, retirees could be facing two big problems. One, higher tax rates in the future to cover the national debt or fund new programs. Secondly, less control over income timing due to required minimum distributions. This potentially causes your tax brackets to spike in retirement. Without action, retirees could unknowingly pay far more in taxes than expected, shrinking their nest egg faster than planned. That's why proactive tax planning isn't optional, it's essential. Now here's where it gets interesting. There's a new proposal circulating in Congress right now. It's nicknamed the One Big Beautiful Bill Act. Now, no surprise, it's massive, covers a lot of ground, but here's what matters for those nearing retirement. A new retirement fairness rule. We love that, don't we? Retirement fairness rule. Could place a surtax on large pre-tax withdrawals, especially for high earners or those with significant IRA balances. Proposed changes to RMDs, pushing the age back further, but increasing the withdrawal percentages once they begin, and a controversial one, phasing out Roth conversions for certain income levels starting in 2027. Some of it is still being debated and the bill isn't final. But this is the direction things are headed: more complexity and potentially more taxes for those who've saved the most. So what can you do? The best time to plan for taxes in retirement isn't when you're already taking required minimum distributions. It's before you retire or in the early retirement years when your income might be more flexible. If you're in or approaching that stage of life, let's talk. We help clients right here in Murfreesboro and across the country create retirement income strategies that are tax smart and future focused. You've worked hard to build your savings. Now let's make sure you keep more of it. And together, we can help you put your retirement on cruise control.